Well, the election's only a week and a half away, so I thought pretty opportune time, Zach, to sit back and talk through some of the big impacts that, the election result, either way it goes, could have a big bearing on what your investments look like. So, what are your sort of thoughts initially?
Yeah, well, typically right-leaning governments have performed better for the local share market since Federation, so they've had around 12% gains compared to left-leaning governments, which have had around 8% gains on average. There are, however, a lot of policies that have been floated about that could potentially impact a lot of listeners' investments and viewers out there. Like they could potentially have negative or positive
it's giving
effects.
Plenty of people in the news something to write about and talk about. So.
Yeah, exactly. So I thought we'd go through 5 of the probably biggest ones out there that's going to affect Australians' investments and how they might potentially impact on them.
Okay.
So we might start with the biggest one, which is negative gearing. So this is the one that probably people have heard about the most. So what that means is under a short and Labor government, negative gearing will be limited to new housing, which starting from 1st of January 2020. Okay. Yep. So pretty soon. Grandfathering will apply to all properties purchased before the 1st of January 2020.
Okay.
And the Coalition has no proposals to change the current negative
business
gearing.
As usual?
Yeah, business as usual for that.
Yeah.
So how will this impact?
Yeah, I think the obvious ones are property purchase decisions. So I think people are reading into this, there may be a little bit of an influx of property purchase decisions brought forward. So if someone's considering, and it's the right decision for them to buy an investment property, there may be a sort of an impetus for them to actually go and sort of get this done before January 1st. So we may actually see a bit of a spike, or at least a sort of a slowdown in that sort of the crash that we've sort of seen in property prices of recent times. So, and what this might mean is there might be a bit of a hangover. So if we're talking about what happens January 1st, 2020 and beyond, is there a bit of a hangover where there's no people purchasing or less people purchasing new properties for investment purposes? So might also play some, make some changes to what things look like from a rental perspective as well.
Yep.
But yeah, hopefully what it means for the intended policy was to try and make it sort of more affordable from a housing perspective. So what it might see is actually the people that can't get into the property market might actually be able to find a home at sort of a reasonable price. So that might be the silver lining in all of this.
Yep. Yeah, so those are really good points. So the next biggest policy is the franking credits. So under a Labor government, their policy is to reduce, though you can still reduce tax, but you'll no longer get the refund for excess franking credits. So this particularly applies to self-funded retirees who are on, not paying any tax or paying little tax at the moment, and when you're getting those fully franked dividends come through, you're getting some money back. And then similarly with people who are on low to no tax rates, they will also potentially get affected. What are the impacts here that you see?
Yeah, I think you're right. Like self-funded retirees are the big people that are going to be impacted. So what traditionally was, after sort of lodging their tax return or getting an influx of cash into their portfolio returns, that's no longer going to be there. Obviously, you will be able to offset other tax that you have payable, but there'll be no longer that sort of kicker that comes in addition to that on the cash side. So I think returns will be a little bit more sort of muted from an Australian equities perspective. It actually is sort of, we're already seeing it, so people are jumping the gun a little bit and actually making changes to asset allocation, which I'd sort of suggest, better to just wait until we actually see what comes out of this. We've still got an election to get through, so we don't know the outcome yet. We're jumping at shadows a little bit. So that'd be sort of the big one where there might be more money flowing out of sort of high-yielding ASX-listed businesses, so doesn't put pressure on their share prices. Do people sort of, sell off the banks, Telstra and those sort of dividend stalwart businesses in sort of search for more growth or other types of income like infrastructure, real estate, all those sort of types of investments as well. And I think there will be more of a rebalancing that people actually have less money just invest in Australian equities. So traditionally, self-managed super funds are very much overweight Australian equities compared to international. So I think that might be an actual benefit that comes out of all of this.
And it is important to note too, what I didn't say before, is that anyone on a government pension or any type of allowance is exempt from these new changes, so they'll still get the refunds back. Similarly to self-managed super funds that have one member who's receiving a government pension or allowance, they'll still be exempt as well.
Yeah.
But you need to have that member in the fund before 28th of March 2018.
Oh, so you can't put anyone.
Yeah,
slide
so you
anyone
can't
past.
go and try and find someone who's on the pension and try and get them into the SMSF to try and beat that as well. So they've thought ahead on that one.
Yeah, that's a good point. So no time machine sort of will need to wheel out Doc's DeLorean. So
that's it.
So what have we got next? So we've done franking credits. So
yeah, so the next one is income tax changes. So this is quite a big positive for most people earning under the 180,000 mark.
Yep.
You're going to see some tax changes under both. So the big difference here is that for lower income earners, Labor's giving more of a tax cut, but are then increasing people earning $180,000 or above.
Yep.
Every dollar you earn over that is going to be an extra 2% taxed. That's what they call their budget repair levy. So similarly, Labor is going to agree to or uphold everything the coalition said in their budget.
Yep.
They're just going to give extra cuts on the lower end, and then more tax on the higher end.
Yeah.
How do you see this impacting people?
Well, it's pretty simple. For high income earners are going to pay more tax. So, we're going to get up to the point when you include Medicare levy up to 49%. So that's pretty significant. So what it may mean is people rethink, their urgency. Do they want to sort of take on extra workload, the extra stresses that come with it? Will they chase returns? To be honest, I don't think an extra 2% is going to make or break anyone's decision making, but it is still significant. So it's all part of that return. For lower income earners, hopefully what it means is dealing with cost of living is going to be a little bit easier. So what's happened over the several years is bracket creep. So because people's wages have gone up with inflation and sort of the tax brackets have stayed where they are, we've in effect actually lost a bit of purchasing power with the money that's coming in. So what it is, and sort of why I think there's bipartisan support on this, is general living expenses for most Australians, everyone will benefit. People at the top, you are going to lose a little bit of sort of your purchasing power as well. And what hopefully happens is that money gets put to good use, so it actually does stimulate some economic growth and ultimately help the economy. So that'd be a really good thing, because I think they're going to spend on things like education and healthcare. So what you might see, and a little bit of an indirect flow on, might be those businesses that are listed in healthcare and sort of education might be sort of worth a look, because they might get extra support and stimulus.
Yep, perfect. So on the next big policy change is the capital gains tax. So under Labor, their proposal is to halve the capital gains tax discount for any assets held over 12 months from 50% to 25%. So the rules around having to hold it for the 12 months still remain the same, but the discount goes in half, so from 50% to 25%. And this is for all assets held held after 1st of January 2020, and it's grandfathered back.
Yep.
So any assets held before 1st of Jan 2020 will still get that 50% discount if held after over 12 months, but then afterwards it goes down to 25%. The coalition has no changes to this policy.
Yeah. Impacts for this one, I think, the ones that jump off the page are they've been added incentive to actually hang on to investments a little bit longer. So those investments you've already got in your portfolio are going to be that much more valuable, because when you go to sell them, you're going to keep more of the actual returns in your pocket. So I think there's going to be just a really good investment behaviour to actually hang on to those investments a little bit longer. And then ultimately what it's going to do is dampen returns a little bit. So if you are on a high marginal tax rate, you'd probably want to be holding on to those investments until you have a low income year. So maybe taking a career break, or perhaps waiting till retirement. In terms of turnover and investments, I think will be the main impact there. But ultimately, you should be holding on to investments long term. But this is a big one. They're basically halving the discount. So especially if you're on a high marginal tax rate, you're gonna feel
property purchase, that's a sizable asset.
Especially if your property, like people over the last 8 or 10 years or so have experienced hundreds of thousands of dollars of gains. That at an extra 25% is going to be quite significant. So just do your research. Make sure you're speaking to your accountant about what's the actual net return on your investment. So don't go sort of making rash decisions on selling investments until you know what's going to land in your pocket.
So the last proposal that we're going to talk about, number 5, is the changes to discretionary trusts. So under Labor's proposed measure from 1st of July 2019, all discretionary trusts, which are also known as family trusts, will be subject to a minimum income tax rate of 30% for the distributions, and those are to beneficiaries aged over 18. regardless of the income tax bracket that that person may be in. So these don't apply to special disability trusts, testamentary trusts, fixed trusts, cash management unit trusts, fixed unit trusts, or public unit trusts. And the coalition has no proposal to change the current way that discretionary trusts are taxed. So who will this impact?
Yeah, it's the big ones. Like the one that jump off the page here are small business owners and SME individuals, say, who are sort of running a business. A common structure for those was to have a discretionary trust as a way to sort of distribute the income at the end of the year and sort of manage how much tax they pay. And these are sort of driving a lot of Australia's growth, and they're not multinational companies by any stretch, but as a way that sort of they're able to sort of level the playing field and actually make it work, because they are obviously sort of by nature smaller business and have a lot of family members involved in a lot of cases. Case in point, look, we've got a discretionary trust as part of our strategy, but also people that run it from an investment portfolio perspective. So where you build a portfolio, you structure it, you can actually manage your capital gains as well. It does help from an overall portfolio construction. So those people really need to sort of do their homework and actually consider, is this still the best structure for me? I think it might breathe some more life into investment bonds, because they're going to offer a 30% tax rate as well, and actually some benefits beyond that if you do hang on to it beyond 10 years. And again, it might drive money more into the super system. So I know a few people have lost some confidence in the superannuation system, but it still offers a more tax effective rate of 15%. So I think there might be an incentive to see more money flow to those structures, and it might mean that people need to sort of revisit how they set up their business as well, because we might see more businesses get set up as proprietary limited companies instead of a family trust moving forward. So.
Perfect. And as we said at the start, so obviously everything's proposed at the moment. So when government gets formed, depending on what that looks like, by the time these proposals potentially get through and get made into law, they could look very different. So don't jump the gun at any stage.
I wouldn't be jumping the gun. Don't make any rash decisions now, because once you've made the decision, quite long-lasting impacts of those, and you can't just go back and sort of with an eraser and change it. So, be patient. Wait until we sort of see how it all plays out. And we might sort of do something similar and do a bit of another fireside chat and work out what actually needs to play out. And then, beyond that, we need to still wait till it becomes legislation as well. So, see who gets those preferences.
That's it. As always, email us at connect@pekada.com.au if you've got any questions, and we'll see you next time.
Beautiful.